Good afternoon, everybody. Welcome to our May Crowdercast for Venture Carolina. I appreciate your time this afternoon. We're going to have a session this afternoon that covers a bit more of a wide-ranging ground than the subject-specific questions that we covered in our previous Crowders. So welcome to this Ask Us Anything About Angel Investing session. I look forward to talking to you for about an hour this afternoon. My name is Paul Clark. I'm one of the managing directors of the South Carolina Angel Network. We are an affiliation of the angel investment groups that look at investing in early stage companies across Western North Carolina and South Carolina. We have been running these Crowdercast workshops and Q&A sessions over the last few months to try to introduce more people to angel investing, try to help people who are interested in what we're trying to do and potentially interested in raising money go about doing that in a more efficient way. And we have done a number of these sessions and appreciate some regular viewers coming back to watch us for this one as well. To give you a little bit of background on what we're trying to accomplish, particularly for viewers who are new to this platform, you will see on the right-hand side of your screen a column where you can submit questions. And the point of this session is for me to answer the questions that you guys have about angel investing and entrepreneurial activity. So I certainly encourage you to please ask some questions along that column. There's also an area there where you can vote on other people's questions. So the questions that are most popular go to the top of the list, and I'll address those first. If you're interested, you can contribute to this session. Certainly no obligation to do that, but if you find some value in these sessions and in the questions that are answered during them, we'd love to have your contribution. That contribution is to Venture Carolina, which is a 501c3 nonprofit. So there's a tax-deductible contribution for you. And we'll talk more about what Venture Carolina is and does in a minute. And you can see the link to that contribution button down just below me. And as I say, we're very interested in answering your questions. That's what these sessions are for. So please don't be shy. Ask whatever questions are on your mind. And I will do my best to answer them. If you want to follow up online after with me, you can contact us through our website, scangelnetwork.com. There's a connect with us session there, and my email is paul@scangelnetwork.com. So we'll be very happy to answer you offline directly there as well. To give you a background on the participants, so I'm one of the three managing directors, as I said, of the South Carolina Angel Network. Matt Dunbar runs our group in Greenville, which is called UCAN. Charlie Banks runs our group in Columbia, which is called Capital Angels. And together we help the other groups around the state and in Western North Carolina as well to operate as part of an integrated network. We have about 230 people who are members or investors in those groups. We also have a couple of angel investment funds that invest alongside those groups. And collectively, we invest our own private capital in startup companies across the Carolinas and the Southeast. So that's what SCAN does. I'll talk a little bit more about that in a second. This is a workshop that's actually brought to you by Venture Carolina. Venture Carolina is our educational nonprofit arm that was set up a few years ago now to provide education to potential investors, to help teach them how to become angel investors, how to make investment activity they're doing already more efficient or more effective. And it's also designed to help entrepreneurs, not in the general sense of trying to help them start up businesses or help companies grow, but in the fairly specific subject of helping them raise early stage capital so that they have the financial resources to go and execute their business plans and their dreams. So that's what Venture Carolina does. As I say, if you're interested in contributing, then please do, but there's no obligation to do that. This is a free workshop. But please do submit questions, and I'll happily stay on here for as long as I can to answer questions. So please do submit those. To give you a little bit more of a background on what we do at a very high level, so every month our individual angel groups meet. We have groups, as I say, in Greenville, Spartanburg, Anderson, Asheville, Rock Hill, Columbia, Aiken, and Charleston, the Low Country Angels group, and we've got some other groups in formation in Hilton Head and Myrtle Beach. So we cover a fair amount of territory between those groups. About 230 people are members of those groups, which means they pay a fee to be part of that group and come every month to be part of the meetings. In those meetings, we typically see one or two entrepreneurs pitch their business to us. Those are the best couple of entrepreneurs that we can find from across that area over that month. We then give them a grilling on their pitch. If we like them enough, we take them through the due diligence process. If we like the results of that due diligence process, we report the results back to our groups the following month. And then to the extent people like what they saw and like what they heard from the diligence report, we pass the hat and we make an investment in an early stage company. Just to give you a bit more of a granular sense of what that involves. So we are equity investors, which means we take a share of the companies that we invest in. We don't lend to companies, and we're not looking for an 8% cash return in a cash flowing company. We're early stage equity investors. And we typically try to invest anywhere between $250,000 and $750,000 in companies that are more than just an idea, but typically not too much more than a proof of a concept with a first few customers. The ideal scenario for us is that a full management team is in place. They have a good idea, they have some validation, they have some traction with some initial customers, and they're raising money to significantly expand the scope of their operations, to invest in sales and marketing and public relations, and really grow a business very quickly. There are some questions in the queue already about what we look for in terms of angel investment, so we'll go into a bit more detail on that later. But as I say, that's the kind of investment we're trying to make. So we're not trying to invest in high street companies, in lifestyle businesses that are just being set up with one or two people to just earn a living from. We're looking for high growth, high impact, usually high tech companies that have the capacity of growing very rapidly and generating a good return for equity investors, and that are high risk. So we anticipate along the way some of the companies we invest in won't make it, but some of the companies that we do invest in will. When they do, they'll make it significantly and potentially generate a good return for investors and have a good impact on the local communities in which we operate. The motto of our groups is make money. So we are unabashedly for profit on the investment side. We want to make good investments and make good returns. But our motto is make money, have fun, and do good. And the meetings are a fun way to interact with passionate entrepreneurs and with other fellow members that have insights and business experience that you can learn a lot from. And then on the do good side, we are supporting the next generation of entrepreneurs. A lot of our members are successful entrepreneurs in their own right that have made money on their previous ventures and are reinvesting that into the next generation. And from a purely economic development perspective, early stage companies that have been around for less than 5 years are the net contributor to job growth. So they're the only type of company that have added jobs over the last 30 years. It's fairly obvious that early stage companies do that and older established companies die and don't do that. But it's important to recognize that's a significant part of economic development and the future sustainability of a successful economy. And in general, early stage investing like ours is not top priority for more traditional economic development. So the do good part of what we do is an ancillary benefit, but I think one that deserves some recognition. So that's what we do in a nutshell. That's enough of hearing what I want to tell you, and I'm happy to answer your questions now on things that you want to know about angel investing. So please keep those questions coming. I'll start with my first question. This question is from Brooke. How do you go about finding investments? So we get investments from a wide variety of places. We typically are aiming to invest in a 4-hour or so driving distance of the groups that we've got. So we look for deals and we prioritize the deals that come to us if they're within that kind of driving radius. 93% of the capital that we've invested has been in companies based in the Carolinas. So we find deals locally from a variety of places. Our best deal flow source and our most proprietary deal flow source really is the connections and the contacts of the members of our group. So we've got 230 people, as I said, that are members or investors in our group. They're some of the most connected and influential business people and community leaders in the Carolinas. So they are very adept at finding potential investment opportunities for us, and some of our best deal flow comes from them. Aside from that, as you probably would expect, we're well connected with all of the efforts to assist early stage companies. And that might be from a legal perspective or an accounting perspective, helping companies get set up in the first place. We have good relationships with corporate attorneys and with IP attorneys in particular, and accounting firms. Some of those are sponsors of our groups. Elliott Davis here in Greenville and Borknight Beatrice and Stormer in Columbia, for example. So they send us some deal flow potentially for people that are approaching them. And then from a less private sector perspective, the incubators and accelerators that have sprung up around South Carolina produce a large amount of deal flow that is potentially of interest to us. Some of it's a little early for us, but a lot of it, after a little bit of incubation and maturation, is interesting for potential angels. So we get investments from there too. The largest source by volume is just people contacting us through the website. So it doesn't take a great deal of skill to Google early stage capital South Carolina, and we're going to come up. And we get a lot of incoming deal flow from incoming entrepreneurs seeking capital. That's not always the best high quality deal flow that we could ask for. Some of those incoming emails are not necessarily great introductions to a company. There's a question later on that's going to talk about how to pitch. We'll talk about that a bit more there, but that incoming deal flow tends to not be quite such high quality because potentially the entrepreneur hasn't necessarily done the same level of homework as they would have done had they come to us from a direct referral from a member of our group, who at the very least has acted as kind of an initial screening agent for us to send us good quality deals. So short answer from everywhere, and we encourage anybody to connect with us. Finding the most high quality deal flow typically comes from our investors and from the team ourselves who are out trying to find those companies. Question from Molly: what does the diligence process involve? And so it's a great question that's of relevance for both investors who are looking to try to guarantee a good return for themselves, and for entrepreneurs that are trying to figure out what the process looks like and how to best position themselves to go through it. So just to give you some background, so we go through a screening process where we take in these companies that I mentioned when I was answering Brooke's question. We screen them, we have them pitch to a committee of our angels, and then we have them pitch to the full group of our angels if they get through that gauntlet. Once they're at the point of pitching to those groups, the groups typically either vote to take them into a due diligence process or not. And assuming they get through into that, the diligence process itself typically goes over the course of about a month. It doesn't require full-time commitment for that full month, but that's the time frame over which we try to do it. And we do it in a couple of different ways. We have, first of all, we have a standard diligence request list of all the documents that we would like to see. And the most well-organized companies can proactively respond to that by having their documents, well-organized and ready to come over to us. We share those through a Dropbox or some equivalent platform like that. And that covers corporate documents, business plan, all of the materials around sales and marketing plans, their headcount, their financial projection model, some thinking from the company on what their exit strategy might be, the deal documents, obviously, for the investment that we're going to make, if those have already been prepared, which they haven't always. Sometimes we help with the creation of those. And so we get all of those materials and we try to digest them over the course of a week or two. And then we have a series of meetings with the management team to ask our questions, some from those documents themselves, some more higher level discussion questions about what the company's trying to do and how they're going to go about doing it. And so over the course of about 3 weeks, we ask all the questions that we can think of. And bear in mind, these are early stage companies, so a lot of the questions revolve around the background and experience of the management team and how well suited they are to deliver on a business plan that has got relatively little traction behind it so far. We're not like an established private equity fund that can go and look at 10 years worth of financial performance to figure out where this business is going from here. So we ask all the questions that we can of an early stage company. We do some reference checking. We potentially do some interviews of some current customers or some potential customers, and some of the other people that are around the business, attorneys, accountants, or whoever else it might be. And we digest all of that and we synthesize the results of that into a report back to our angels. And we evaluate businesses on the same 10 criteria each time so that we can compare how this company looks compared to the other 60-something companies that we've completed a due diligence process on, and try to calibrate how well it performed relative to other potential investment opportunities. And then once we've been through that process, we then pass the hat and make an investment or not. So from the entrepreneur's perspective, it's probably about a 6-week process of pitching and then providing materials for the diligence process. It's 3 or 4 meetings after they've done the roadshow to pitch to provide the materials and to answer questions from the angels. And then it's a couple of weeks after that to know whether or not there's enough appetite from our members to make an investment. That's if things go according to plan. If schedules don't work out very well, or the documents and materials aren't ready for us to do that initial digesting before we have our meeting, then it can take over 2 months or 3 months, or sometimes longer if things have to happen before we're comfortable making an investment. But typically that 6 to 8 week process is what we do as a diligence process. Another question from Molly: at the earlier stage than the diligence process, what are some things investors look for in a pitch? So it's a pretty wide-ranging question, and it certainly varies depending on which kind of investors we're talking about. For our groups, we're looking for companies, as I say, in that go-to-market stage, so they've got some initial traction and looking to raise equity capital of 250 to 750 typically. Our number one criterion when we're evaluating companies is the quality and strength of the management team that's presenting this idea to us. Ultimately, we're betting on, can this management team deliver on the opportunity and strategy they're presenting to us? And so much more than later stage companies might be, this is a bet on the quality of the management team, what their individual skill sets are and how well they're likely to work together as a team. And if we come with a positive evaluation of that, then we're quite likely to make an investment. And if we don't, regardless of the other attractions of a business, we probably aren't going to make an investment. So that's the most important thing. We did a series of blogs on our website about which criteria in our evaluation set appears to be most significant when evaluating a particular company. And its management team wins. The size of the market's important, obviously. The size of the potential for this business to grow is important. Deal terms is very important. So even if you have a very attractive looking idea, but your deal terms are not the same kind of market level terms that we would typically see, or make it difficult for us to see how we could make the 10 times our investment that we're trying to make, then that deal wouldn't happen either. So if you want to read through those blogs in a bit more detail, that can give you some more granularity too. But at a higher level, we're looking for a very strong management team. We're looking for a product or service that can scale very quickly. So we're looking for a company that can give us returns of 10 times our investment in 5 years. That's about a 50% annual rate of return, which is obviously very high relative to just about everything else you might try to invest in. But we need that because we know half the companies we invest in are going to fail ultimately, or return less than the capital that we invested in them. So we need to average out some very big winners with the failures in our portfolio to make a good overall return. So we need companies that can scale very quickly, that can grow very rapidly, that therefore operate in not a very niche market, but operate in one that has some significant potential. We're also interested in companies that really know very well where they're going to go from their marketing perspective, how they're going to get that scale. And it doesn't always necessarily matter what that is, as long as there's a very clear progression about how they're going to get there. A lot of companies have great ideas. Very few companies can actually sell them to people. So that's a key part of our diligence process. Obviously, we're interested in whether there's competitors in the space and whether you're going to be battling Microsoft or other startup companies for getting a foothold in the space. We're interested in the technology and the IP underlying the business, although a lot of things we invest in are software companies, so there isn't necessarily a lot of kind of patented IP in a lot of those, but some kind of technology advantage that helps you deliver on the business plan you're looking for. And typically, we're looking for companies that can scale without a lot of follow-on capital. So in a lot of places, an angel group might just be a feeder for a VC fund to put in the next $5 million of capital and a PE fund to put in a bunch more after that. We're somewhat disadvantaged in the Southeast, although in some ways blessed with a relative lack of venture capital and other later stage capital to follow on behind us. So when a company is pitching to us, they need $1 million now and $10 million next year, that's a harder pitch for them to do than if they can deliver on what they're trying to tell us with $1 million or so now, and potentially bank debt or other forms of financing later on. So that's a particular wrinkle that we're interested in because of the financing environment that we sit in the Southeast. That's probably a longer answer to the question than you were hoping for, Molly. We had a session back in January, I think, on how to pitch to angel investors, and there's some material in that session and in the slides of that workshop that give you a better sense of some more detail around some of the things that I was talking about. Next question is from Ashley. What items should be in a business plan / marketing plan when someone is pitching to an investor? So that's an interesting question. Let's take the business plan part of that first. So for the most part, if you're going to be approaching us by sending us a 50-page business plan, we're not going to read it. That's not the most effective way to approach an angel group. A 2-page executive summary that covers the key points that we're interested in is much more effective as an initial introduction. A 2-line elevator pitch by email with an attached executive summary in PDF is the right way to approach an angel group. So we're not typically interested in reviewing a business plan until much later in the diligence process when we really want to dive into the details. So I guess the first part of the answer is don't send us a business plan. That might not be true for all investors, although I think it's probably true for a lot of investors. We want to see a summarized version to see if it fits with our criteria and see if it gets us excited enough to take you through to the pitching process. When you're in that process, items in a marketing plan is a slightly different question. So we want to see a marketing strategy and a marketing plan that fits well with what you're trying to do. And so it can't be too definitive on what that might look like. If you're trying to sell a retail product, then you need to be able to prove that you have the distribution networks or the branding skills or whatever it might be to make that B2C play work. If you're trying to sell to school districts, you need to prove that you've got members of your team that have done that before, that understand how to do that. If you're trying to sell to other businesses, if you're trying to do enterprise sales to big companies, you need to be able to prove that people on the team have done that before, that you have the building blocks in place to do that effectively. We have a lot of people in our group that are very successful marketing experts in a whole range of different capacities and industries. So we can pretty quickly come to an informed view on whether or not this plan is going to work. If it looks like it fits the industry or the opportunity well and is well thought out, and there's some proof behind the return on investment figures on a particular ad buy strategy or whatever it might be, then we're more likely to invest. But if the marketing plan is, we're going to optimize on social media and we're going to have, we're going to tweet a lot or we're going to build content, it needs to be a bit more granular and a bit more specific and a bit more clearly thought out and relevant than a list of particular marketing tactics might be. So hopefully, Ashley, that answered your question. If not, then feel free to throw in a follow-up question. Question now from Brooke is, what are some ways to increase female entrepreneur funding? That's a good question. It's a topical question and one that is of widespread discussion across the whole technology industry, across the US. It's obviously a much bigger question than we can solve just in the South Carolina Angel Network. But just to give you a few thoughts from us. So we've invested in a number of female entrepreneurs over the course of the last few years. Earlier this year, we funded 2 back-to-back female-led companies in Emergy in Atlanta and Target Pharma Solutions in Durham. So we have a number of very well-qualified, very talented, very effective CEOs of the companies that we've invested in already. But they are still a small minority of the pitches that come to us, particularly of the high-tech companies of the kind that we're really interested in investing in. And I think that's a structural question to do with the workforce and the flexibility and the history and the just the culture of startup tech companies that is way beyond my capacity to do very much about. But there are certainly some ways. So there are female-only angel groups, for example, that operate not within our groups because we don't have necessarily the critical mass in any town to put together a female-only angel group. Although we do have a significant minority of our investors are women. But there are angel groups not too far away that specifically focus in early stage female entrepreneurs, and they should certainly be on your list to call on if you fit that criteria. I think the work that's being done to just incentivize more startups is therefore going to help more female startups. I think changes to the workforce and demographics are going to solve some of those problems in themselves. I think certainly if you look at younger entrepreneurs, there's more participation from female entrepreneurs there than older entrepreneurs, for example, which is true of the workforce in general. So I think some of those questions may have some answers that help answer themselves. I don't think there's a ton that we can do about that locally, but we're certainly receptive to ideas and suggestions for how we might do that. So, Brooke, if you have any concrete suggestions, I'd love to hear them. Question from Thomas next. Do investors want to know what the money will be spent on with timelines and who will be hired? And if so, when do they want that information? They do, yeah. How the money is going to be spent is one of the first questions that's asked during the pitching process, or really during the screening process, because that really outlines the parameters of what the bet we're making is. If it's we need $1 million to create a prototype, that's a completely different conversation from we need $1 million to hire an inside sales force and go and sell this thing that we've already created. So we want to know exactly what the money's going to be spent on in fairly granular detail at the point of the pitching process. And as referring back to the question about a management team, who will be hired? So absolutely, if there's a particular hire that you need to make to go and execute the business plan you're going to do, and some of this funding is to go and incentivize that person, we want to know at the very least what the skill set is of that person, and ideally who that person is, so that we can evaluate whether or not that person in collaboration with the rest of the team can be effective at delivering what the CEO typically is presenting to us. So yeah, we want to know at the point of the pitch. We certainly want to know during the due diligence process who exactly is going to be hired and what the investment from us is exactly going to be spent on. We also want the entrepreneurs to go and then do that. It's not that unusual to see companies investing or receiving investment and not doing exactly what they claimed they were going to do during the pitching process, for legitimate reasons sometimes, but also we want to see evidence that you're doing what we said you were going to do. And we want that information early on in the process. It doesn't need necessarily to be too granular. Certainly if there's some confidentiality questions, or the potential hire is working somewhere else and doesn't want to be identified too publicly, that's fine. We can certainly handle those issues during our diligence process, but we do want to know that information. Question from Caroline: how many people are active angel investors in the area? So we have 230 people in our groups from Asheville down to Charleston. There's another small fund, the Pinnacle Fund in Western North Carolina, that has another dozen or so people in it. There's a group like ours in Charleston Angel Partners, that has another 40 or so people in it. So probably 300 people total that do this in some kind of formal way through an angel investment group or fund. There are 115,000 millionaire households in South Carolina, according to a study by Deloitte a few years ago. So obviously we're scratching the surface of the potential for people that are out there that could be making investments like this. Across Western North Carolina and South Carolina, we get a fraction of those people. Probably several hundred of those are doing investments of their own outside of our group. We know that a number of people are claiming the South Carolina Angel Investor Tax Credit, for example, that aren't part of our groups. So there's probably a couple of thousand people maybe across the whole geography that are viable targets to make an investment in the angel space. But they're pretty hard to find, other than us and those formal groups finding individuals that are interested in making investments in companies they don't know already, outside of the friends and family type angel round. It's pretty hard to find them. They are there. There's plenty of wealthy people in the Carolinas. They're not all focused on making early stage capital investments, but they're out there. But I don't think there's a more efficient way to find them or to pitch to them than joining a group like ours. Question from Thomas: can you think of any upcoming pitch competitions where winners receive any sort of resources, mentoring, seed money, publicity, or web hosting? Yeah, there's several. There are several places to find them. Universities run a lot of pitch days. A lot of graduating students from Clemson's entrepreneurial MBA program is having their pitch competitions over the last couple of weeks. I think there might be one more of those to go. So there are university-related pitch competitions like that. There are demo days and graduating classes from incubators, from the Harbor Accelerator in Charleston or the Iron Yard here in the upstate. Plenty of places like that. There's a pitch competition next month in Asheville to judge who might come to our Asheville Angel Group meeting over the summer. That's a more public forum for pitching than we typically would do, so that would qualify. There's a number of kind of more geographically spread development organizations from Atlanta through to Tennessee, through that curve through to North Carolina, that do to frequent pitch competitions and other gatherings of angels and entrepreneurs, or potential investors and entrepreneurs. So typically those have some kind of prize money for winning. They typically lead to offline conversations between people who are interested in the pitch and the company, which can be a softer form of resources. Winners of those competitions obviously receive publicity. More practical things like web hosting, I'm not sure there's any competitions really that cover those kind of operational things. But certainly publicity and seed money, or at least prizes from those competitions are pretty common. So I think you can probably find a lot of those online. Another follow-up from Thomas: have you had any companies receive an SBI or STTR grant? Yes, we do. All of our portfolio companies have won those and are applying for many more of those. Kiatech here in Greenville has won a bunch from similar looking, similar grants to that. Nirvana Sciences up in Durham has won in several of those. So yeah, those are a pretty well established and actually very effective form of non-dilutive funding for early stage companies. And we have several successful applicants that have been through that process. So if you have a particular problem or effort you want to talk, you want some advice on that, Thomas, I'm sure we can find people who've been through that process that can help you with that. Follow-up question to that is, so our grant proposal process is considerably simpler than a lot of proposal processes. I mean, a 2-page executive summary for us is exactly what we want to get through into the process. Later on, then the data we're asking for is probably comparable to a much more thorough application. But at the first few steps in our process, it requires a well thought out and lots of work behind it. But a 2-page summary is fine, and a 12-page PowerPoint presentation for our groups is fine too. It doesn't need to be a work of art or some kind of magnum opus to get through those stages. So we're set up slightly differently than a lot of grant application processes would be. If a company receives a government grant application before approaching angels, is that more attractive? Yeah, no, it is more attractive. So one of the problems, as I mentioned, is follow-on capital for us. $500,000 sounds like a lot, but it doesn't actually go all that far. If it lasts you 2 years, that's probably a pretty good result. Sorry, I lost my train of thought there. Yeah, so lots of other forms of capital, financing capital beyond ours, is what we hope a company can find, and often they can't because the VC community is not particularly well developed in South Carolina, certainly, and is typically a bit later stage even in North Carolina. So other forms of funding, wherever that might be, a Kickstarter campaign to sell a few products, a governmental grant, and those are absolutely fine. An SBA loan if the company's been around a little bit longer and is getting to a position where they can qualify for that kind of financing. The SC Launch Program, which is another early stage, they invest convertible debt in companies in South Carolina, for example. Wherever you can find money that doesn't dilute the angels and doesn't come with too many strings attached, that you can actually use productively and efficiently, we encourage you to go after, and we're delighted when people get, because it gives them a bit more of an opportunity to get to a good result, even on the limited amount of capital that we can invest. One final comment, question from Thomas: if we wanted to pitch to angels, which would we send first, in email? Yep. A sentence or two elevator pitch with a 1-page or 2-page executive summary, that's perfect, and we will answer that and we'll get back to you. Make sure it's well spelled and it's addressed to the right people, and we'll answer those. If it's a life story on an email, we're probably not going to. If it's a please read my attached business plan and that's it, we probably aren't going to spend a lot of time on that, or even sometimes reply to that. But an elevator pitch and executive summary is definitely the way to go. Question from Marcus: how did the SC Angel Network get started? So the South Carolina Angel Network really got started in 2013, but the history of it goes back a little bit further than that. So Matt Dunbar, who runs our Greenville group, and a number of business leaders in Greenville got together in early 2008 and set up the Upstate Carolina Angel Network, which is a 55-member strong group that's been around in Greenville since then. And that's really the genesis of more or less everything that's been built on top of that. Matt and that group really learned the trade of angel investing, learned how to make these groups work, educate a lot of people on what that looks like. And a number of people around the groups have said over time, this is a great thing for Greenville to have. Why can't we have one of these in Spartanburg or Asheville or somewhere else? And Matt never had the capacity to go out and launch those groups himself. And then Charlie, who runs our Columbia group now, really came on board with Matt to try to expand out of Greenville. And I saw what those guys are doing and jumped on board that bandwagon and have helped expand that further. So we really started doing that in 2013. We launched the group in Columbia in 2014, and it has taken off pretty quickly since then, as we've figured out a way to make a 12-person angel group in Anderson work. Just to have one of those on their own will be pretty much impossible without the infrastructure of the statewide effort behind it. And then to dedicate the resources and the time and find the partners on the ground in places like Spartanburg and Asheville to set up those groups themselves. And we're still learning how to make those groups operate effectively together. We need to try to balance deal flow from Asheville, for example, with investors across a much wider network who could look at it. We need to make that process efficient for the entrepreneurs so they don't feel like they're spending all their time in pitches and due diligence processes. But I think we're starting to get that nicely operationalized. So it's not too difficult, and the resulting investment capital is well put together and well organized and a very efficient way to raise an angel round. I think we're going to continue to learn, continue to improve that, continue to launch new groups in and around South Carolina, continue to find other avenues for passive investors, for example, that don't have time to be part of those groups, to be part of sidecar funds that we've launched in the past and will continue to work on. We'll do more education and continue to increase the outreach to people. But we think we've done a pretty good job so far. There aren't too many relatively poor states that are spread out like ours that have a 200-person angel group across the state operating effectively. So we think we've built something here in South Carolina that's pretty impressive already, and we're going to continue to improve it as we go. Is it common for the entrepreneur to buy the company back from his saved salary during the exit rather than sell it to another company? From our portfolio perspective, no. All of our exits in our portfolio come from either the company running out of capital and being wound up, or the more positive and actually more frequent result is the company's being bought by a competitor or a strategic partner or some other player in the space that finds them an attractive acquisition candidate. I don't think, or at least it certainly shouldn't work, the math shouldn't work, that the entrepreneur has made enough money in terms of salary to be able to afford to buy back the company. We're looking, as I say, to sell these companies for 10 times what we invest at. And so if we invest in a company on a $2 million valuation, say, I don't think most entrepreneurs are going to make $20 million in salary to pay that back over 5 years or 10 years to be able to afford to do that. I suppose some wealthy incoming entrepreneurs might be able to do that. But for the most part, our exit strategy is to have the company bought by some other larger player in the space with the financial resources to do that. Another question from Thomas. Thank you. These webinars are great. They're good fun to do as well. So I encourage people to try to do their own if they're interested. We invite anybody. Yeah, we don't spend a lot of time marketing these. It's aimed at both our existing members to ask questions if they're interested, and potential entrepreneurs to ask their questions too. So we publicize this probably fairly inadequately on our social networking, and we send emails to people. I don't know how many people view them all the time. We've got a list, so I know some people are listening to me, but I don't know necessarily who they are or who they're viewing on behalf of. But we encourage anybody to participate. If we're not answering questions that you want answered, then we encourage people to ask those questions. So if you know people that will be interested, please feel free to forward on the link to the next one. What proportion of companies that you see pitched do you invest in? Question from Caroline. So our overall funnel from companies that we take seriously at a screening level at the beginning and end up investing in is about 3%. We've seen about 1,600 business plans or approaches to us that have been high enough quality or authentic enough for us to spend some time on. And then we've invested in 48 companies so far at the end of that process. So it's a pretty high burn rate between incoming and investment. We've seen about 225 companies actually pitch to the investors. So from that perspective, it's a little bit higher. We've done due diligence on about 125 of those companies. So it's still not easy, but once you actually get in front of the groups, we've already invested a fair amount of time in you to get you to that point. So those are legitimate and, in our view at least, convincing enough to be worth the time of the angels to see the pitch. And so after that, the investment rate is a little bit higher. But it's hard to get investment from angel groups. And if you look at other VC funds or private equity funds, they'll tell you the same kind of 2 or 3% investment rate is pretty typical for capital providers of that kind anywhere. We do try to send that other 97% somewhere useful. There aren't always obvious places to do that. We don't always have the time to do that effectively. But we do try to make the effort to send you to other equity providers or early stage lenders. And actually, a quick plug for that: there's a session on Thursday evening for alternative capital providers in the upstate. So if you are interested in learning more about that, the 10 at the Top Economic Development Organization in the upstate is having an alternative capital provider event, which I'd encourage people, either those providers or potential entrepreneurs, to go to learn more about what the options are. That organization also has a good list of capital providers of all kinds. They're on their website. Josh Dorfman, who runs Venture Asheville in Asheville, also has a very good diagram of the different resources for early stage capital. So although we're a very small subset of companies, and we're a very small subset of those companies that actually we fund, there are other resources out there that people don't always know about, that might be helpful for you in your fundraising ambitions. Experience in the industry is important when looking for potential board members. What advice can you provide for choosing investors to pitch to? So my advice is go where you can, where you think your company will resonate. So if it's a retail company, go to places that have financed retail companies before, and don't come to us because it's wasting your time, it's wasting ours. Try to find sources of capital that invested in companies that look like you in the past, that have the same kind of business model or industry expertise, or whatever kind of characteristics your business has that you think they would find attractive again. Now, of course, that's easier said than done because there aren't that many sources of capital like that in the Carolinas. If you're willing to travel, then I certainly would encourage looking outside of the area too, to try and find other well-informed capital that could understand what you're doing faster than perhaps a generalist investment group like ours could. But my advice is simply to find investors wherever you can, and try to engage with them in whatever way they want to be engaged with, and try to make your pitch fit the criteria they're looking for. And ideally, it already fits the pitch. You don't have to massage it to do that. Try to narrow down your list of potential targets so it fits what you're trying to find. Thomas says he's typed up the transcripts of these videos. Well, great, thank you, Thomas. If people would like to read them, then great. If we could find a way to put them on our website, I'd be happy to do that. I don't learn anything from watching videos either. I'm a text and document reviewer person. So if that is your way of learning and absorbing information, great, Thomas. Thank you for doing that. We'll follow up with you afterwards to make those available. The government cares about boosting minority, women, and economic disadvantaged companies. Do angels care about these things, or just potential dollars? Well, we do care about those things. The thing we care about most is a good return on investment. So if those things can convince us they can make a good return on investment, which very often they can, because the business model they put together relies upon the marketing of that status or whatever it might be, then great. But we don't go out of our way to look for those kinds of companies or that designation or any particular designation. We're interested, as I said, in companies that can produce a great result, and how they do that is up to them, but they just need to be able to prove that how they do that matches their strategy and goal. And if it does, then we'll certainly be willing to spend a lot of time learning more about what they're doing. Trying to talk SBDC into scholarships for interns so they receive hands-on experience, startup experience. I think it's always a good idea to try to get more people involved in early stage companies in whatever way they can. I think the SBDC doesn't have unlimited resources, and certainly the startups don't either. But if you're willing to do internships with companies for the educational aspect and the minimum wage requirement the startups have to pay interns, and everybody does to pay interns, I think it's a good idea. The more experience you have of seeing what startups look like, that you're learning not on invested dollars from us is good news for us. So we strongly encourage any activity like that. Can you provide an estimate of how many companies that receive phase 1 grant receive phase 2 in South Carolina? Thomas, I've got no idea. Certainly the companies that we've invested in, if they've gone from a phase 1 to a phase 2, they've been successful. But that's obviously a very small subset. So no, I can't really tell you, I'm afraid. If a company has pivoted a good bit since their initial business model, is a sign they might not be right for the job? Possibly. We certainly look at the history of a company pretty thoroughly when we're evaluating a business plan or a particular investment opportunity. Sometimes it's a good thing. So they experimented and were unsuccessful in or refined their strategies. They went forward, and that pivot or development may be a good sign. If it's symptomatic of a management team that don't really know what they're doing and they're flailing around trying a lot of different things without a good plan, then yeah, that certainly might be a sign they're not right for the job. But we wouldn't necessarily look at that negatively to start with, and we would certainly take the time to learn about historical complexity. We're well aware that the startup companies are frequently cobbled together from various efforts that one joint venture partnership or one equity partner might not have worked out, so they move on to something else. And we'll take the time to learn about that. And if we think it's a sign of adaptability and taking advantage of opportunities that found along the way, we give credit for that. We don't penalize for that. Another question from Thomas. You mentioned a $20 million exit. What is the highest exit? So we've sold 6 companies. We've sold them. A lot of information on private company exits isn't public. We have sold companies, or we've been involved in companies that have sold for more than $20 million. We've sold some for considerably less than that too. The team that now runs Babies, which is a portfolio company of ours, ran a company, predecessor company to that is publicly known, was sold for $96 million, and that was an angel investment from primarily from the Charleston Angel Partners, but other people involved in that too. So there are relevant, recent, and local examples of companies being sold for several tens of millions of dollars once they've proven their proposition and got some traction. We're hopeful that some of the companies in our portfolio now could potentially be in the several $100 million range by the time they come to exit. Some of that is things need to go well for that to happen, but it's certainly not impossible. But for some of the companies that we've got, will be in that kind of status in the next 1 or 2 or 3 years. Your follow-up question was, how much of companies an entrepreneur founder usually retained by exit time? Well, that really depends on how much capital they've raised along the way. So if all they've done is raise money from us, they probably own, as a team, 75% of the company, and we're a 25% shareholder. If they go through another round of VC money, again, the VC is going to take another 25%, so that dilutes the management team down to, it's not exactly right math, but let's say down to 50%. And if every several rounds of that, particularly if they had to do it at low valuations because things haven't gone according to plan, they could be, single-digit or low double-digit shareholders at that point, which may not be the ideal result, but being a 10% shareholder in a $100 million company is still a pretty nice result. So entrepreneurs can still make a lot of money, even having gone through several rounds of investment capital. But they typically aren't majority shareholders at the point of that exit. Another question on exit, Thomas. During the typical exit, do original entrepreneurs, I think I should say, usually keep their job, or does the buyer usually want them replaced? Well, it's typical that the next round of funds, if it comes from a private equity fund, would want to keep the existing management team on board at least for a while, potentially for the life of their investment. If it's a strategic buyer, again, they probably at the very least want to have some handover time. We're typically hoping to get the business into a position where it's not wholly dependent on that founder, so can exist without them. It's got structures and operational expertise in place to do what it needs to do without the founder. But the acquirer may not necessarily want to bring them on board, and the entrepreneur may well not want to go from being the head of a company themselves to being a smaller cog in a larger machine. So it's not always certain that exiting entrepreneur wants to continue either. But for the most part, at least at the beginning, there needs to be some continuity, make sure that the business continues to function. And so at least for 6 months, and often for longer than that, there's some continuing service from that entrepreneur to the acquiring company. How common is it for a successful exit entrepreneur startup founder to become an angel afterwards? Well, it depends where you are. So in South Carolina, not hugely common because there just aren't that many exit entrepreneurs that are ready to reinvest in the next round. I would say, at a guess, maybe 15% of the investors in our group are in that situation, maybe a little higher than that. But in other places, there are whole angel groups dedicated to just simply having exited entrepreneurs go back into raising or investing in the next generation. So in those places, there's a group, I think it's called NextGen, that recently launched in Durham, North Carolina, that does only that has only investors only from that background. So although we don't have a long track record of that kind of recycling of capital in the Carolinas, or Western North Carolina and South Carolina particularly, it's certainly a commonplace elsewhere, and probably one of the reasons why historically there hasn't been that much angel activity in the Carolinas. Compared to starting another company, entrepreneurs typically are serial entrepreneurs. It's very rare that they just do one and then give up. And that's true of both ones that become angel investors and then or at the same time start their own companies as well. So yeah, entrepreneurialism seems to be a bit of a bug, and once you've caught it, then you typically go around and keep trying to do it several times over. Question from Caroline: can you go into more detail about how those who don't have time to attend angel meetings can get involved in angel investments? Yes. So we launched in 2014 a sidecar fund, which is a committed capital fund that invests alongside the angel groups that we run. And so that is primarily for people that don't have time to come every month to review companies and don't have time to go through the materials on their own, to review the diligence reports or watch the pitches that we video. And so that vehicle is aimed at them. It has now pretty much fully invested, and we're in the process of launching another one over the coming months to be the successor to that fund. But that fund's goal was, or that fund's operating method was, whenever the angel groups made an investment of a certain size, it was at least 5 angels invested $100,000 collectively, and then that fund would automatically co-invest with them. We described it as kind of the index fund approach to angel investing. It was in all the investments that the angels made that were of sufficient popularity, and then investors in that fund get frequent updates from the fund on what it's been doing and what the performance of the portfolio companies is, but doesn't require those fund investors to actively analyze and authorize an investment in any given opportunity. So we thought that was a good way for potential investors to participate in a fairly low time intensive way. And we had 48 investors in that fund that agreed with us and invested capital of their own in that fund. And hopefully we can have similar funds than that in the future as well. There are other ways that you can participate. So even if you're an active member of our group, if you don't necessarily have time to come to the meetings, we allow you to look at all the materials, the due diligence reports, and all the materials that go into the synthesis and creation of those reports through a platform where you can see those materials or view the pitches that we videoed in your own time, and therefore get familiar enough to make some investment decisions on your own in the groups. And then there are other more passive vehicles. So if you want to do more of a crowdfunding type online platform, there are others out there that you can use to do that. There are other ways to participate if you're willing to invest a bit of time. None of those type of platforms require a particular set timetable for a meeting, so potentially a bit more flexible for people to join. But the passive is the fund that we had is called the Palmetto Angel Fund, and There's some materials on that on our website too if you're interested in learning more about that or about potential funds that might come along after that when it's finished. A couple of last questions from Thomas. We're getting close to our hour, so I'll give you back some time. Do angels prefer companies that are singularly focused, or is it acceptable to have multiple business models? For example, 3 revenue streams. So pretty singularly focused. If you have 3 multiple business models, that's probably going to be a bit of a turnoff for us. But if you have 3 pretty closely related revenue streams that follow the same business model or similar constituent base, that might be attractive. We've typically seen the failures in our portfolio where a company hasn't been sufficiently focused on really succeeding in one specific business model or channel or sales and marketing technique, and have spread their efforts too wide to really get traction in one place and have run out of capital before they've been able to really succeed on that. So we're very concerned during the diligence process to make sure that the primary goal and all of the kind of primary channel to market and whatever else is plausible and convincing in itself, and that additional business models or go-to-market channels are potential ancillary things that they could explore over time, but they don't necessarily need to execute 3 different strategies at the same time. And so that will also vary depending on the company and the management team's background and capabilities. But the simpler the story, generally, the better for our groups to get behind. What are the most common mistakes that startups have made after receiving investment? For example, pursuing patent litigation. So patent litigation is not really a huge problem or area for us that's been a challenge. Typically because there just aren't the resources even to engage upon patent litigation against other people. Although we do have one portfolio company that's been able to do that. The biggest mistakes, I think, are not sufficiently focusing on one goal or objective, as I mentioned in answering the previous question. And another is basically not being able to put together a sales strategy. A lot of companies struggle with a product, with some initial traction, to come up with an effective strategy. And it's surprisingly hard to hire talented sales leaders that can both design a strategy and execute it. And so that's the biggest challenge. I'm not sure that's necessarily a mistake. Maybe underestimating the difficulty of that is a mistake. But that's typically the biggest challenge that both of our successful startups have struggled with, and our least successful startups have really failed to overcome. And then I think this is the last question from Thomas. How often have your startups been hit with patent litigation? I don't think they have at all. I think Matt can probably give a better answer to that, but it's pretty unusual. We try to avoid. We do a bit of work on the diligence side to see if what the company is doing is likely to infringe somebody else's patent, and the entrepreneurs have typically done some of that as well. The companies that we invest in are typically too small to get on the radar of companies that have the finances to go out and really be an active patent litigant. Now, I've said that I'm sure we'll be inundated with problems, but for the most part, that isn't something that has come up too much in the companies that we've participated in, Thomas. And certainly, relative to other things to worry about, just simply running out of capital because you haven't delivered on your sales and marketing plan is a much bigger thing to worry about from our perspective than potential patent litigation further along down the line. So I think that answers everybody's questions for today. I appreciate the variety. Thank you to Thomas particularly, but also to all of the people that contribute questions. Hope that you found some useful answers. If there's questions in there you'd like some follow-up to, then please let us know. Please contact us. We have another session like this one at the end of June where we're going to be talking a bit more about returns to angel investment and some of the recent trends in crowdfunding and other similar regulatory changes that might be of relevance to both investors and entrepreneurs. So we'd encourage you to join that if you're available to do that. And as I say, please let us know if you have any questions. But other than that, thank you all for your time, and I hope you enjoyed it. And I look forward to seeing you again soon.